In this video, I'm walking through one of the most important parts of the CAMS framework, and that is the international architecture behind anti-money laundering and counter-financing of terrorism compliance. Seminar 3 is really about understanding where a huge amount of our AML and CFT expectations come from. This is not just about memorizing names of organizations, it is about understanding the role each body plays, how they differ, and how the exam may try to test those differences. What matters here is that I keep 3 core pillars in my mind from the very beginning. First, the Financial Action Task Force, or FATF. Second, the Basel Committee on Banking Supervision. Third, the European Union Directives on money laundering. If I lose that structure, the material can start to feel like one long blur of standards, recommendations, due diligence rules, and regulatory language. But if I keep that map in my head, this whole seminar becomes much more manageable. The safe way to think about this is simple. FAT sets the global standard. Basel focuses on banking supervision. The European Union uses directives to create legally binding outcomes for member states. That is one of the most important distinctions I want to remember for the exam. FATF is not Basel. Basel is not the EU. And the exam may try to blur them together because all 3 talk about AML and CFT controls, due diligence, monitoring, and risk. My job is to slow down and ask 3 things. Which body is this? What does it do? And what does it not do? So in this video, I'm going to walk through the big picture first, then FATF, then Basel, then the EU directives, and then I'll bring them together at the end so the comparisons are clear and memorable. Chapter 2, FATF Overview. Let me start with FATF. FATF stands for the Financial Action Task Force. FATF is an intergovernmental body and a multinational group. It was founded in 1989 by the G7. It is based in Paris, France at the Organization for Economic Cooperation and Development, where it has its own secretariat. At the highest level, FATF provides guidance for anti-money laundering to governmental bodies around the world. Why was FATF created? Because countries were developing their own laws and approaches in different ways, and criminals could exploit those gaps. If one country tightened its controls but another jurisdiction lagged behind, criminal activity could simply move to the weaker system. So the purpose of FATF was to establish a shared international standard and help create consistency in how countries think about money laundering, terrorist financing, and related threats to the integrity of the international financial system. Chapter 3. What FATF does and what FATF does not do. This is where the exam may try to confuse me. FATF is a policy-making body. It sets standards and promotes the effective implementation of legal, regulatory, and operational measures for combating money laundering, terrorist financing, and other related threats. FATF works to generate the political will to bring about national legislative and regulatory reforms. But FATF does not enact laws and regulations itself. And FATF does not impose penalties and fines. That contrast matters. FATF is powerful, but its power is in standard setting, influence, monitoring, and driving reform. It is not a legislature, and it is not a global enforcement agency. Chapter 4. FAT Objectives. So when I think about FATF, I want to remember 3 core tasks. First, it spreads the AML message worldwide. Second, it monitors the implementation of the recommendations among FATF members. Third, it reviews money laundering trends and countermeasures through typology's work. That means FATF is not just writing standards and then walking away. It is also checking how those standards are implemented and studying how criminals continue to adapt. Chapter 5. FATF Membership. Now let me look at FATF membership. FATF membership consists of member jurisdictions, regional organizations, observers, and associate members. Membership is not random. FATF looks at strategic importance. That includes the size of a jurisdiction's gross domestic product, the size of its banking sector, its population, its impact on the global financial system, its commitment to AML and CFT efforts, the level of AML and CFT risks it faces, and the efforts it makes to combat those risks. FATF also considers adherence to financial sector standards, participation in relevant international organizations, and geographic balance. An important point here is that it is not necessary for a country to be compliant with all 40 recommendations at the moment it becomes a member. That is useful because it reminds me that FATF membership is not based on perfection, it is based on strategic relevance, political commitment, and progress. Chapter 6. FATF membership process. The membership process happens in two stages. Step 1 is engaging with the country and granting observership. The country provides a written political commitment, endorses and supports the FATF recommendations, agrees to undergo a mutual evaluation during the membership process, and agrees to participate actively in FATF. FATF then conducts a high-level visit to verify those commitments and assess whether the country can realistically move through the process. Step 2 is the mutual evaluation and granting of membership. Membership is granted if the mutual evaluation is satisfactory. If the country is close but not quite there, it may need to follow an action plan to address deficiencies. Chapter 7. Non-cooperative countries and territories. Another topic I need to understand is the original FAT practice of identifying non-cooperative countries and territories. This was the old naming and shaming process. In 2000, FAT published an initial report on non-cooperative countries and territories using 25 criteria consistent with the FAT recommendations. The goal was to reduce the vulnerability of the financial system to money laundering by identifying jurisdictions with inadequate AML controls or poor cooperation. But by October 2006, there were no more non-cooperative countries and territories, and that initiative ended. The newer process shifted to FATF's public statement and the ongoing process for improving global AML and CFT compliance. So I need to remember that NCCT is older FATF language, not the current framework. Chapter 8. FATF 40 recommendations. Now I move into the heart of FATF, which is the FATF 40 recommendations. These are the key element of FATF's efforts. They have become the world's blueprint for effective national and international AML and CFT controls. They are recognized as the international standard for combating money laundering and terrorist financing, and they set the minimum standards of action for countries to implement according to their own legal and institutional frameworks. The first recommendations were issued in 1990, and then they were revised several times, especially in 1996, 2003, and 2012. The safe way to remember the revision trend is that FATF grew broader, more risk-based, and more sophisticated over time. Chapter 9. FATF recommendation. Revisions. Over time. The 1996 revision extended the money laundering offense beyond narcotics trafficking, brought in non-financial businesses and exchange houses, and reinforced suspicious activity reporting. The 2003 revision added a clearer definition of money laundering, added terrorist financing, widened the categories of covered non-financial businesses, and prohibited shell banks. The 2012 revision included proliferation and tax crimes, expanded the definition of politically exposed persons, strengthened national risk assessment expectations, and reinforced group-wide AML. So I do not just want to memorize dates. I want to hear the development. FAT started narrower and became broader, more risk-sensitive and more detailed. Chapter 10. FAT. Recommendation structure. The FAT 40 recommendations are easier to understand when I think of them in groups rather than isolated numbers. The first group focuses on policies and coordination, especially risk assessment, risk-based approach, national coordination, and cooperation. The next group focuses on money laundering and confiscation. Then there is a group on terrorist financing and proliferation, including sanctions and non-profit organizations. Then there is a large preventive measures group for financial institutions and designated non-financial businesses and professions. After that comes transparency and beneficial ownership of legal persons and legal arrangements. Then there are powers and responsibilities of competent authorities. And finally, there is international cooperation. That tells me the recommendations are not random. They form a full AML and CFT framework. Chapter 11. FAT, Financial Institutions and DNFBPs. I also need to understand how FAT defines a financial institution. It includes institutions that accept deposits, provide lending services, provide financial leasing, transfer value or money, issue and manage means of payment, issue financial guarantees, trade in securities and related instruments, provide portfolio management, invest or manage funds, underwrite life insurance and related investment products, and engage in currency changing. Then I have designated non-financial businesses and professions or DNFBPs. These include casinos, real estate agents, dealers in precious metals and stones, lawyers, notaries, accountants, and trust and company service providers. That matters because FATF is not just about banks. it is also about gatekeepers and non-bank channels where money laundering risk can sit. Chapter 12, FATF, Customer Due Diligence. Now, I want to slow down on customer due diligence because this is high yield. FATF Recommendation 10 says financial institutions must be prohibited from keeping anonymous or fictitious name accounts. They must conduct customer due diligence when establishing business relations, when carrying out occasional transactions above 15,000 US dollars or euros, when conducting certain wire transfers above 1,000 US dollars or euros, when there is suspicion of money laundering or terrorist financing, or when there is doubt about previously obtained customer identification data. The CDD measures themselves are clean and worth memorizing in exam-ready language. First, identify the customer and verify the customer's identity using reliable information. Second, identify the beneficial owner and take reasonable measures to verify that person. Third, understand the nature and purpose of the business relationship. Fourth, conduct ongoing due diligence. That is the four-part package I want to hear in my head if the exam asks me about FATF CDD. Chapter 13, FATF Enhanced and Simplified Due Diligence. FATF also gives examples of higher risk factors that may require enhanced due diligence. Customer risk factors include unusual circumstances, non-resident customers, complex ownership structures, nominee shareholders, bearer shares, and cash-intensive businesses. Geographic risk factors include countries with inadequate AML and CFT systems, countries subject to sanctions, or jurisdictions with high levels of corruption or criminal activity. Product and service risk factors include private banking, anonymous transactions, non-face-to-face business, and payments from unknown third parties. Enhanced due diligence can involve obtaining additional customer information, establishing source of funds and source of wealth, understanding the reasons for transactions, obtaining senior management approval, conducting enhanced monitoring, and requiring the first payment to come through an account in the customer's own name with a bank subject to similar CDD standards. Simplified due diligence is possible in lower risk scenarios, but only where justified. Chapter 14, FATF Record Keeping, PEPs, Correspondent Banking, MVTs, New Technologies, and Wire Transfers. Record keeping is another very testable area. FATF Rec says institutions should maintain records for at least 5 years after the business relationship ends or after the date of an occasional transaction. 5 years is the key number I want to remember. FATF Rec also gives additional measures for specific customers and activities. Politically exposed persons require stronger controls, especially foreign PPs, including senior management approval, source of wealth and source of funds review, and enhanced ongoing monitoring. Correspondent banking requires deeper understanding of the respondent institution, assessment of its AML and CFT controls, senior management approval, clear allocation of responsibilities, and no relationships with shell banks. Money or value transfer services need to be licensed or registered and subject to AML controls. New technologies require risk assessment before launch. Wire transfers require accurate originator and beneficiary information to remain with the transfer throughout the payment chain. Chapter 15, FATF Internal Controls, Suspicious Reporting, Beneficial Ownership, and FIUs. FATF also covers reliance on third parties, internal controls, and foreign branches and subsidiaries. Institutions can rely on third parties for some parts of CDD, but they cannot outsource responsibility. They can delegate the task but not the responsibility. FATF requires internal policies, procedures, controls, training, independent audit, and a management-level compliance officer. Group-wide programs matter. FATF also requires suspicious transaction reporting. If a financial institution suspects or has reasonable grounds to suspect that funds are proceeds of crime or related to terrorist financing, it must promptly report the suspicion to the FIU. Safe harbor protects reporting institutions from liability when reporting in good faith. Tipping off is prohibited. Beneficial ownership transparency matters. Shell banks are prohibited, and countries should establish financial intelligence units to receive, analyze, and disseminate suspicious activity reports and related information. Chapter 16, FAT, mini recap. So let me pause and do a mini recap. FATF is the global standard setter. It was founded in 1989 by the G7. It sets standards and promotes effective implementation, but it does not itself enact laws or impose fines. Its 40 recommendations form the global blueprint for AML and CFT. It covers risk assessment, offenses, confiscation, terrorist financing, preventive controls, beneficial ownership, supervision, FIUs, and international cooperation. If I get confused, I bring myself back to the phrase, FATF sets the global standard. Chapter 17, Basel Committee Overview. Now I move to the Basel Committee on Banking Supervision. This is Basel, not FATF. The Basel Committee focuses on banking supervision. It was established by the governors of central banks, and its role is to improve supervisory cooperation and strengthen the quality of banking supervision around the world. Whenever the exam starts talking about banking supervision, prudential concerns, or the soundness of banks, I should start thinking Basel. Chapter 18. Why Basel matters for AML and CFT. Why does Basel matter in AML and CFT? Because banks without proper due diligence requirements can face serious risk. The seminar specifically highlights reputational risk, operational risk, legal risk, and concentration risk. Those are classic Basel-style concerns. FATF is broader and more global in its AML and CFT architecture. Basel is more focused on what weak AML and CFT controls do to banks and why supervisors care. Chapter 19, Key Basel Guidance. The foundational Basel paper is Customer Due Diligence for Banks from 2001. This paper established minimum standards for customer due diligence and know your customer expectations in the banking sector. What matters here is that Basel sees strong CDD and KYC as essential to protecting the safety and soundness of banks and the integrity of banking systems. Later, Basel published Consolidated KYC Risk Management in 2004. The point here was group-wide control and consistency. Then later, Basel revised and combined relevant guidance in the 2016 paper called Sound Management of Risks Related to Money Laundering and Financing of Terrorism. That title alone is worth remembering because it reflects Basel's angle, sound management of risks. It is supervisory and prudential language. Chapter 20, Basel Risk Themes and the 3 Lines of Defense. What does Basel expect a sound KYC program to include? The exam tends to focus on 4 necessary elements: customer acceptance policy, customer identification, ongoing monitoring of higher risk accounts, risk management. Basel also expects banks to understand the background of the customer's country of origin, and business activities. Another very useful Basel concept is the 3 lines of defense. The first line is the line of business. The second line is AML compliance. The third line is audit. That is a clean, memorable structure. Business owns the activity. Compliance provides oversight and challenge. Audit independently reviews and tests the system.
Chapter 21, Basel Group-Wide Supervision. Basel also stresses the need for group-wide risk management expectations. That means parent institutions need consistent standards across foreign branches and subsidiaries. They need customer acceptance policies, customer identification processes, ongoing monitoring, and robust internal information sharing so they can manage risk across the group. This is where a common exam trap appears. The exam may give me a risk term and ask which one Basel specifically associates with weak due diligence. I want to remember the group clearly: reputational risk, operational risk, legal risk, and concentration risk. The safe way to think about Basel is this. Basel cares about AML and CFT because poor controls threaten the stability, soundness, and governance of banks.
Chapter 22, Basel Mini Recap. Now let me do a quick Basel recap. Basel means banking supervision. It is linked to governors of central banks. It focuses on the prudential and supervisory consequences of weak AML and CFT controls. Key concepts include customer due diligence for banks, consolidated KYC risk management, sound management of AML and CFT risks, reputational risk, operational risk, legal risk, concentration risk, and the 3 lines of defense. If I hear banking supervision, I should think Basel. Chapter 23, European Union Directives Overview. Now I move to the European Union Directives. This is an EU directive point. The European Union AML Directives are issued by the European Parliament and implemented by member states as part of domestic legislation. Their purpose is to prevent money laundering and terrorist financing and create a consistent regulatory environment across the EU, while allowing some flexibility through domestic legal implementation. What matters here is that EU directives are more legally forceful within the EU system than FATF recommendations or Basel guidance. Chapter 24, First and Second Directives. The first directive was adopted in 1991. It required member states to enact legislation to prevent their domestic financial systems from being used for money laundering. It confined predicate offences largely to drug trafficking under the Vienna Convention, though member states were encouraged to extend them further. The second directive was agreed in 2001 and required stricter money laundering controls across Europe. It extended the first directive beyond drug-related crimes and expanded criminal activity to all serious crimes, including corruption and fraud. It explicitly brought currency exchanges and money remittance officers under AML coverage. So the first directive is narrower and earlier. The second directive broadens the scope. Chapter 25, Third and Fourth Directives. The third directive built further on the risk-based approach and brought the EU framework more closely into line with revised international standards. This is where the EU framework became more developed around customer due diligence, beneficial ownership, suspicious transaction reporting, and politically exposed persons. The fourth directive took things further again, especially on beneficial ownership, transparency, and the risk-based approach. It strengthened customer due diligence and pushed harder on the requirement for information to be available about the beneficial ownership of legal entities. So if I hear third and fourth directives, I should think stronger risk-based AML, stronger due diligence, and growing beneficial ownership transparency. Chapter 26, Fifth Directive. The fifth directive strengthened the regime in several important ways. It made national registers of beneficial ownership, excluding trusts, publicly accessible and required regulated entities to provide adequate, accurate, and up-to-date information. It improved cooperation and information sharing between regulators. It strengthened monitoring of high-risk third countries. It added a more streamlined, enhanced due diligence approach for high-risk countries, including extra information gathering on customers and beneficial owners, source of funds and source of wealth review, senior management approval, and stronger transaction monitoring. It lowered the prepaid card threshold for anonymous use from €250 to €150 for in-store purchases and €50 for online purchases. It strengthened identification of politically exposed persons, and it expanded the scope to sectors and persons such as estate agents, auditors, external accountants, tax advisors, art traders, custodian wallet providers, and exchanges between virtual currencies and fiat currencies. So when I hear fifth directive, I want to think more transparency, more cooperation, lower prepaid thresholds, stronger PEP treatment, and broader sector coverage, including crypto-related activity. Chapter 27, Sixth Directive. The Sixth Directive moves into an even stronger legislative stage. At a high level, the Sixth Directive reflects the EU's effort to tighten and modernize the framework even further. It reinforces stronger institutional coordination, stronger FIU capability, more supervisory alignment, and a more modernized legal framework around financial crime. For exam purposes, I want to associate the Sixth Directive with the tightening and modernization of the EU AML framework, rather than treating it as just another minor amendment. Chapter 28, EU Directive Progression. Now I simplify the whole development. The first directive begins the EU AML legal framework and is narrower, especially around drug trafficking. The second expands predicate offences and brings in exchange houses and money remittance offices. The third deepens the risk-based approach and strengthens customer due diligence and PEP treatment. The fourth strengthens beneficial ownership transparency and the risk-based framework. The fifth expands transparency, high-risk country controls, prepaid card thresholds, PEP identification, and coverage of sectors, including virtual currency businesses and art market participants. The sixth reflects the newer legislative stage aimed at strengthening the EU's anti-financial crime framework even further. Chapter 29, EU Mini Recap. So let me pause and recap the EU section. EU directives are legal instruments within the European Union. They are more legally forceful inside the EU than FATF recommendations or Basel guidance. The exam may test which directive introduced which major change, especially around predicate offences, beneficial ownership, PEPs, prepaid cards, virtual currency businesses, high-risk third countries, and broader legal coordination. Chapter 30, Cross-Framework Comparison. Now I want to bring all three frameworks together because that is where the material becomes easier to remember. FATF sets the international standard. FATF gives countries the blueprint. It tells them the essential measures they should have in place to identify risks, pursue money laundering and terrorist financing, apply preventive measures, improve transparency, strengthen supervision, and cooperate internationally. Basel focuses on banks and banking supervision. It is concerned with how weak due diligence, poor KYC, and weak governance expose banks to reputational, operational, legal, and concentration risk. Basel is more prudential and supervisory in tone. The EU directives are legal instruments for EU member states. They turn AML and CFT expectations into binding legislative outcomes within the EU system. So if FATF is the blueprint, the EU directives are part of how those kinds of standards become law in Europe. Chapter 31. Exam traps and memory anchors. This is where the exam may try to confuse me. It may give me a question about a body's role and then mix in a responsibility that belongs to another body. If the answer says something about setting global standards and promoting implementation across countries, that sounds like FATF. If it says banking supervision, central bank governors, or sound management of AML and CFT risks in banks, that sounds like Basel. If it says directive, member state implementation, or stronger legal force within Europe, that sounds like the EU. Now I want to finish with exam traps and memory anchors. First, this is an application-based exam, not a pure memorization exam. Second, I need to read carefully when terms are opposites or easy to confuse. A classic example is terrorist financing versus counter-financing of terrorism. Third, I need to know what a body does versus what it does not do. FATF does not enact laws. FATF does not impose fines. Fourth, I need to watch threshold traps. FATF CDD for occasional transactions points to $15,000 or euros. FATF wire transfer transparency points to $1,000 or euros. FATF record keeping points to 5 years. The Fifth Directive lowers anonymous prepaid card thresholds to 150 euros in store and 50 euros online. Fifth, I need to watch timeline traps. The first directive is older and narrower. The second expands predicate offenses and covers exchange houses and remittance offices. FATF revisions in 1996, 2003, and 2012 show broader scope over time. NCCT is an older FATF practice that ended in 2006. Basel's major guidance evolves from customer due diligence for banks to consolidated KYC risk management to sound management of risks related to money laundering and financing of terrorism. Sixth, I need to recognize when the same theme appears in multiple frameworks but in different ways. Chapter 32, Final Recap and Closing. In this video, I've walked through the 3 pillars of Seminar 3. I've covered FATF, Basel, and the EU directives. The key distinction I want to remember is that FATF sets the global standard, Basel focuses on banking supervision, and the EU directives create legally binding AML and CFT outcomes for member states. FATF gives me the blueprint, Basel protects the bank. The EU translates AML and CFT expectations into law within the European framework. If I keep that structure in mind, the whole seminar becomes much easier to manage. And on the exam, if I slow down, identify the body, identify its role, and then test the answer choice against that role, I'll avoid a lot of easy mistakes. So my final memory hook is this. FATF sets the standard. Basel supervises the bank. The EU legislates through directives. And if I remember those 3 lines, I'll be much more grounded when Seminar 3 shows up on the CAMS exam.